Okay, so today we have a session on the Fed and the crosshairs, independence, systematic monetary policy, GSE reform, and financial stability. Um, th- our session is on Fed independence. And I'm just going to make a few remarks. So we have two speakers on Zoom, and we have Andy. So, yeah, so it's Andy and me. So, central bank independence is the topic du jour in the face of the current administration's attacks on it. And this panel complements a recent conference at Peterson last week that I was at, and a lot of conferences that are going on everywhere. Now, most economists believe in the central bank's operational independence. Yet, and gets back to our roots here, Milton Friedman, 1962, wrote a paper in a book, conference volume edited by Leland Yeager, where he actually was opposed to central bank independence. And that was based on his work with Anna Schwartz, okay, looking at the Fed's record in the first part of the 20th century. And he was very critical of the Fed's discretionary policy actions in its first 50 years, and he advocated instead that the Fed follow his simple K% monetary policy rule. And he even said that the Fed should just be put into a room in the basement of the Treasury, and it would just crank out the money supply at the rate that would keep price stability. But, but the response to the great inflation of the 1960s and 70s was, and Volcker's vanquishment of that was major advancements in economics, which led to a new case for central bank independence based on credibility for low inflation, and independent Fed, which would be transparent and accountable, and following rules like the Taylor rule, instrument rules, would in a sense would work. And this was a strong case for central bank independence. But this created the Great Moderation. But in the past 20 years, we've had several unforced errors by the Fed, which will be talked about a lot today. The global financial crisis in the early part of the century, okay, and the recent pandemic and the inflationary response to that. And so, in a sense, Friedman's warnings come right back. So what does this mean? Well, what I think it suggests, and many of us are going to say, is that you can be independent, operationally independent, but you need to be accountable, and there needs to be oversight. So with those remarks, I'll turn it over to our first speaker, which is Jim.
Thank you, and thanks for the opportunity to speak today on this important topic. I have just a few comments to get our panel going here. Those of you that have heard me speak on this before know that generally speaking, I don't like the term independence. I think it connotes that somehow you're off on an island somewhere, and it's not really like that. So what we should be talking about is a system that makes important social decisions about monetary policy, but is at arm's length from day-to-day politics. And I know people use the term, as Mike just did, operational independence. But independence kind of brings up the idea that it's undemocratic. And I just think that's just not true. You're talking about presidential appointees. And so, what the heck? I mean, all these agencies have presidential appointees confirmed by the Senate. And those appointees have a majority on the FOMC. That's no accident. There would be 7 governors, and they could rule the day if there was something about the decision making that only presidential appointees would know about or care about or something. So in many in many ways, it's very much politically accountable, the system that we have. But there are many further safeguards beyond the presidential appointments that are designed to try to get Fed decision making a little more distant from the goings on inside the Beltway. Among those are the 14-year terms, the Reserve Bank structure, with boards of directors that were intended to behave like private sector boards of directors, and many other features. I think this was a brilliant design, which was motivated by the failure of the second bank of the United States and the first. The founders of the Fed, Nelson Aldrich and others, fully recognized that the central bank would be a political flashpoint, and they wanted, and also I think 19th century politics, late 19th century post-Civil War politics were every bit as much as populist as what we're seeing today. So I don't really buy the idea that we've got more difficult political situation than we would have had then. And they basically came up with a brilliant design that would insulate Fed decision making from politics without completely divorcing it from politics. So this has generally stood the test of time. And that's probably the main success of the Federal Reserve Act, is that it was put in place. It has been modified to some extent, but Congresses over the years have debated these issues repeatedly. And I would say that there's enormous backing of congressional intent to essentially keep the system as it is. And I would also say that politicians generally do not want direct responsibility for monetary policy. I think when Friedman was talking, he would say, well, let's just, the Senate Banking Committee or the Treasury should just make this decision every 6 weeks, and that should be that. And certainly other central banks around the world have done that. But it tends to make the decision making, much closer to day-to-day politics. So I think, my experience is politicians want to be able to complain about monetary policy decisions. They don't want to actually have to make monetary policy decisions. However, I also think that design by itself does not mean that the central bank will be credible. And if you wanted to boil post-war thought on, what gets you good monetary policy, it's one word: credibility. The credibility has to be earned. It's certainly still possible to have poor monetary policy, as we did in the 1970s, even though you have this elaborate design that's trying to keep decision-making at arm's length from politics. So it's a sort of two-step process where you get a design that steps away from the political fray, but that doesn't guarantee success. You still have to earn credibility and actually pursue a good monetary policy. And there's nothing about the design that prohibits bad policy, but it gives you a better chance, a fighting chance to be credible and to get great monetary policy for the country. So I think flaunting or dismantling the design of the Fed would make central bank credibility harder to achieve. Flaunting would be sort of, you leave the institutions in place, but you use informal methods to walk around some of the features that were put in the original design. One place where I think that has happened is salaries of governors. Those were initially if you look in real terms, they were initially quite high, and it would have been considered the kind of job that would be, you would want to stay in for 14 years. And that would give you some degree of being above the fray of day-to-day politics. That has gone away. So now you have people that tend not to stay in their terms for 14 years. And I think on the political side, both parties, I think, like that because they see more opportunities to appoint their guy and possibly onto the Fed, and that's a little bit more politicized than it would otherwise be. So that's a place where you have an informal way. The structure is still there, the terms are still there, but you have an informal way to kind of get around that and erode some of the intent of the original legislation. Dismantling would mean legislation, actual legislation, removing some or all of the protections that are in the Federal Reserve Act that would make the whole process be less arm's length from politics. You could certainly do that, but that also requires a congressional vote. Over the years, I've not seen too much enthusiasm for that. There have been moments where there's been attempts to do something. But again, I don't think politicians on the whole are unhappy with the structure that's been around for more than 100 years. But if you went that route, I think that would indirectly damage the credibility of the U.S. monetary policy, because it would be perceived as moving closer to the political fray. And that would mean that monetary policy would have to take, it would be harder to maintain credibility of monetary policy because market participants would always be attributing political motives to every move that was made. And they would always see the darker side of monetary policy in every decision. And because of that, they would put inflation risk premium into market pricing, and you'd end up with, on average, higher nominal interest rates than you otherwise would need to have. So I think it would be detrimental to go in that direction. But again, this is a dial that, and the Fed is a creature of Congress, and this is a dial that the Congress could turn. And they could get to something that is a little bit less independent from day-to-day politics, or something that's more independent from day-to-day politics. And from the policy point of view, you'd be better off going to more credibility and less day-to-day influence of the political machinations inside the Beltway. So I'll stop there. Thanks, Mike.
Okay, I think let's everybody speak, then we'll take Q&A. So, Jeff, why don't you go ahead?
Yeah, thanks, Mike. Sorry to everyone for me not being able to be with you today. So overt pressure on the Fed for easier monetary policy from the executive branch or Congress, from that matter, is nothing really new. Such pressure has typically been motivated by a desire for stronger short-term growth. A striking feature of the current episode we're in is that we're also seeing pressure motivated by a desire to lower the interest cost of the federal debt. But this type of pressure isn't new either. The Fed has been conscripted several times to finance surging wartime expenditures, after which the government runs primary surpluses to pay down the debt and restore the capacity to finance fighting the next war. Another striking feature of the current episode, however, is that we're now facing large and persistent primary deficits, and we're not at war, at least not in the traditional sense. So I'm not the only one that's somewhat puzzled by what seems like an overly sanguine outlook embedded in longer-term treasury yields right now. One would think that the prospect of higher interest rates on the debt, or the possibility of a resort to inflationary finance, might weigh more heavily on bond prices than they appear to be doing. One should approach market prices, assessing prices in a market as deep and liquid as Treasury securities with humility, of course. But I think the fiscal outlook seems to suggest a reasonably plausible scenario that yields move significantly higher at some point over the next couple of years. And that possibility, if that happens, combined with the political attention to the costs of financing federal debt, I think is likely to shine a spotlight on the Federal Reserve's relationship with the bond market. And I think that's a looming issue for Fed independence. Now, I'd argue that this relationship as it stands now is murky and could pose a significant challenge for the Fed, particularly in the event of like a sharp, sudden increase in Treasury security yields. I think the Fed and the Treasury should clarify that relationship because it relates directly to the Fed's independence and its credibility. A bit of history is useful here. In 1951, the Treasury Fed Accord freed the Fed from the obligation to peg the yields on Treasury securities. The Fed thereby regained control of its balance sheet. Henceforth, the Fed's Treasury portfolio would be the primary means of managing bank reserves and thereby the monetary base and monetary conditions. But the Fed had to forge a new relationship with the Treasury market. This set off a contentious struggle within the FOMC. Chairman William McChesney Martin wanted to restore a free market and foster, quote, an efficiently functioning government securities market characterized by depth, breadth, and resiliency, unquote. He formed an ad hoc subcommittee on the government securities market, which he chaired and which issued a report in November of 1952. The report characterized the market as not possessing depth, breadth, and resiliency, and specifically cited confusion among market participants about the stance of the committee and the trading desk. And there's a little passage I'd like to quote at a little more length here. Quote, the normal functioning of the market is inevitably weakened by the constant threat of intervention by the committee. In any market, the development of special institutions and arrangements that serve to provide the market with natural strength and resilience and to give it breadth and depth tend to be greatly inhibited by official mothering. So the subcommittee report puts scare quotes around mothering. I'm not sure they were called scare quotes back then, but there's quotes around the word mothering. Private market institutions of this kind are repressed, particularly by the constant possibility of official actions, which by the market standards will frequently seem and be capricious. And that's the end of the passage. So Martin argued that the unpredictability of the desk's interventions at various points along the Treasury curve made dealers reluctant to enter into market making. That's what it boils down to. The subcommittee recommended that the FOMC confine its operations to, quote, very short-term securities, preferably bills, a policy that came to be known as bills only. In a compromise, the subcommittee provided an exception, however, for, quote, the correction of or disorderly conditions. Now, Martin's commitment to free markets in longer-term Treasury securities was resisted by the New York Fed. Alan Sproul, president of the New York Fed and a member of the subcommittee, opposed the new restrictions on the desk interventions. He wanted to retain the option of intervening in parts of the Treasury market where, quote, pressure was greatest, unquote, and he doubted that a bills-only policy could provide, quote, a timely relief from the complex pressures in the credit and capital markets created by large Treasury borrowing operations. So one might ask, what complex pressures might be created by large Treasury borrowing operations? And the obvious answer is prices that are lower than the Treasury really wants. So this is sort of a euphemism for prices are too low. The practice of the New York Fed's trading desk, even after lifting the pegs in 1951, was to smooth out the market, especially when the Treasury was coming to market with a new issue, when they would intervene in the when issued market and then after the auctions to support prices. Intervention was discretionary and the criteria seemed highly subjective. The FOMC adopted the subcommittee's recommendations in the March 1953 meeting, but the boundaries around intervention remained contentious. Indeed, FOMC members could not agree amongst themselves on the definition of disorderly. It proved to be a soft and ambiguous boundary. These debates occurred while the Treasury was coming to market with increased funding needs for the Korean conflict. Bills only was a way for the Fed to get out of the way and let the Treasury face investors directly in the market for longer-term debt. It was a way to let market participants determine the appropriate price for the rising supply of Treasury securities. And it allowed the Fed to use its newfound independence to pursue price stability, provided incentives for private sector involvement, investment in market making, and the institutional capacity so that the Treasury market could acquire depth, breadth, and resiliency, which it clearly has. The Fed's debate about bills only in 1953 provides useful insights for today, I think. Questions swirl around the independence of the Fed in the presence of a high debt to GDP ratio and large and persistent primary deficits. In that context, any support the Fed might provide for Treasury security prices would risk being perceived as monetization of the federal debt, akin to the World War II peg regime, adding to the perception of fiscal dominance. That in turn would risk adversely affecting expectations regarding future inflation, and as Jim emphasized, the credibility of the Fed's commitment to price stability. How is the Fed positioned for these challenges? The Fed does not support prices around Treasury auctions and does not, as a general matter, interfere with price discovery for Treasury securities. The Fed has made exceptions, however. The Fed intervened repeatedly in the market for long-term treasuries after the great financial crisis with the avowed aim of pushing down yields. These large-scale asset purchasing programs, as they were called, were limited to and were explicitly motivated by circumstances in which the Fed had reached the effective lower bound. But they do signal a general willingness to manipulate the prices of longer-term treasury securities for macroeconomic goals. More recently, the Fed has intervened in treasury markets for the avowed purpose of supporting what it calls market functioning. This is a descendant of the concept of orderly markets, I think. After a confluence of events led to a spike in Treasury repo rates and the federal funds rate on September 16th, 2019, the desk undertook a series of repo operations in response. It's far from clear the episode would have had any consequence that were meaningful to any of the Fed's policy objectives, but they intervened nonetheless. The Fed also intervened quite heavily in March 2020 in the wake of the pandemic. Market participant views about Treasury yields were changing rapidly in response to incoming news, leading some market participants to pull back from positions, particularly Treasury basis trades. It's fair to say that a good deal of uncertainty remains about the Fed's criteria for intervening in the Treasury market. The distinction between intervention motivated by market functioning and intervention motivated by monetary policy considerations is not at all clear, just as the phrase disorderly markets was unclear in the 1950s. The phrase market functioning suggests some sort of technical or mechanical problem involving the institutional plumbing of the Treasury market, separate from the flows of demand and supply of security trades coming into the market. For example, the software and communications damage that affected the Treasury market following 9/11. But commentary on the 2019 and 2020 market events emphasizes limitations on market-making capacity and arbitrage. Decisions about devoting resources to making a market in a given asset class or positioning funds to be able to buy on the dip to undertake arbitrage operations inevitably depend on the expected level and volatility of asset prices. And those choices are fundamentally an expression of views about the future course of market prices. As a result, large changes in market participants' views about fundamentals can bring about large changes in market functioning. Views about economic fundamentals changed rapidly and suddenly in March 2020, and market making was naturally a byproduct of that. A lack of clarity about when the Fed might intervene to assure market functioning would add to uncertainty and volatility in the event that views about longer-term treasuries shift in a relatively rapid or discontinuous manner. We had a glimpse of heightened volatility in Treasury yields in April of this year. If we see repricing like that again, ambiguity about the Fed's stance toward the Treasury market could add to uncertainty and volatility. In an environment in which the administration has been pressuring the Fed to lower financing costs, there would appear to be a real risk that market functioning intervention is misinterpreted as the Fed's caving in to fiscal dominance. Moreover, the continuing lack of clarity around the Fed's market functioning commitment will also have the longer-term effects that Chairman Martin was worried about, an underdevelopment of arbitrage and market-making arrangements that give the market its natural strength and depth. My recommendation, therefore, is that the Fed ought to clarify its relationship with the Treasury market, particularly regarding price movements and price determination. Notice that the Treasury has activated a buyback program that it uses to provide liquidity in off-the-run Treasury securities. This further clouds the role of the Fed, since the Treasury could use that program itself to support prices at times when the Fed would otherwise intervene. If the Treasury anticipates using the buyback program in times of market stress, it should say so and explain its criteria. Better yet, the Fed and Treasury should agree on who carries out market function interventions. So this would be sort of an updated version of the 1951 Accord. My choice would be that the Treasury is responsible for those interventions. Making the Treasury responsible for market functioning support aligns with the Treasury's general responsibility for debt management. The occasion of an updated accord should give the Treasury its independence to do its own debt management, free from interference by the Fed. The simplest way to do that is for the Fed to return to bills only. An accord could usefully reaffirm the commitment to price stability with the Treasury endorsement of the 2%, formal endorsement of the 2% inflation target. This would be broadly consistent with what many have advocated, that the way to protect the Fed's credibility and its independence for the operational conduct of monetary policy is to limit down, pare down its scope of activities. Thank you.
Yeah, that's great. Okay, so now Andy, it's your turn.
Can you hear me okay? So I'm going to stay seated for a couple of reasons. One is I think it's great that this is a conversation with Jeff and Jim and all of you. These are really tough, challenging issues we really need to think hard about. I think if I stand up, I'll turn into a preacher as opposed to a member of a panel, which is really ideal. I wanted to start my comments by remembering someone who's not here, which is Charlie Plosser, and we really miss him. I miss him personally. I just want to say that when I was a graduate student in the 80s, he was already a hero, and literally you could go back and, if you want, find my dissertation buried somewhere in a library and, cited Charlie Plosser's work already at that time. Then I crossed paths with him again 20 years later when I was working in the Federal Reserve Board, when Ben Bernanke wanted to try to establish an inflation target. Charlie Plosser really honestly played the central role in that. Ben Bernanke's gotten the credit, but it would not have happened without Charlie Plosser. Of course, support from Jim and Jeff Lacker and others in this room and others outside the room, but Charlie played just a critical role in that. I was there and saw it firsthand. And then I got to cross paths with him again 10 years after that, when I was invited to join the Shadow. And so Charlie Plosser is just an unforgettable hero. His courage, his conviction, his wisdom, his kindness and graciousness. Mike and Mickey and others here, I think, knew him much better and could tell probably a lot more stories. And I think my understanding is that we'll hopefully have an event sometime, maybe next spring, where we can think more about Charlie and remember and pay tribute to him. But I just wanted to make sure we don't go any further today without thinking about someone that we wish was still here with us, at this table. Probably that kick me off and send me back to the chair and have Charlie Plosser up here sharing his wisdom about all this. Okay, so having said that, I completely agree with what Jim said. I think the term independence is problematic. If you look back at the academic literature in the 80s and into the 90s, when monetary economists were starting to think about central bank independence, there was a strong emphasis at that time on accountability. That those two things were intrinsically linked to each other, that the central bank is an agency. And those of you who know economic theory, it's principal agent problem, okay? And so the principal is the public and elected officials, and the central bank's an agency of the public and the elected officials. It's not an autonomous institution. And I personally have been really disappointed as years have gone by that, of course, the Fed itself would like to be autonomous. Of course, any agency would like to be autonomous. No surprise there. But what I've been disappointed with is that academic economists and financial market participants and members of the public have not been insisting more on the accountability piece of this. And I think part of why we are where we are today is because of that. And recently, there's a case that's now at the Supreme Court, and you can look at all the amicus briefs. Happy to talk about it during lunch or Q&A, but they're all of those are emphasizing the autonomy of the Fed effectively. There's almost none of them that are talking about the accountability of the Fed and how should the Fed be accountable to the public and elected officials. It's difficult questions. I'm not saying the answers are easy, but I'm saying the questions are important. They should be asked. And when the Federal Reserve is in cases, there's another appellate case that just came up this week. Some of you may have heard about it, the Fed's discretion in issuing master accounts. The fact that the Fed's at the Supreme Court, these are signs here. This is not just one person in the White House. I think both Jeff and Jim said this. I know Mike has said it many times. The history of presidents of the United States trying to exert pressure on the Fed is not new at all. But the question then is, who's the boss? Who's the boss? And the good news, I think, for us, for the United States, the good news is that is answered clearly in the Constitution itself, very wisely by the founders. Okay, there are other countries where it's a bigger problem because they don't have a constitution or the constitution doesn't have much durability. Okay, we have a great constitution, 250 years that we're coming up to celebrate it. What does the Constitution say? It says that Congress has the duty to coin money and regulate the value thereof. Not the president, okay? This is the Congress has the duty to coin money and regulate the value thereof. So we know the answer. And so then all the questions should be revolving around how does Congress carry out that duty? Congress becomes the principal. The Fed can be the agent of Congress. Congress can delegate that duty to the Federal Reserve. But then it has to be crystal clear that Congress is the Fed's boss. And then we have to think about how can you strengthen the accountability, the chain of accountability from the Federal Reserve to Congress. Not to the president. Okay, the accountability is not to the White House. The accountability is to the Congress. Okay, one thing I want to say again, I'm very disappointed here, and this is why I want to stay seated and not stand up because I get too passionate about it. You shouldn't be so surprised that the Supreme Court justices are super smart, amazingly, experts, all 9 of them in different ways, okay? And many of the legal scholars who have all these are experts in the law. But you'll look through all these briefs that have been filed in these federal court cases in this past year. They're completely oblivious to the difference between the first bank in the United States, second bank in the United States, Federal Reserve in 1913, and Federal Reserve in 1935. Mike knows this. Students in my monetary policy class know this. Something dramatic changed in 1935. What? We went off the gold. 1933 is a start, but 1935 is when the FOMC is created in its current form. Okay, we went off the gold standard. From 1789 until roughly 1933, 34, 35, Congress literally regulated the value of money with silver and gold coin standards. In 1935, that ends, and now the Federal Reserve becomes responsible as the agent to carry out the task of regulating the value of money. What this means legally is that the Fed previously could be a private institution, like the first and second national banks, they were private. 2/3 of the directors were private. Okay, and when the Federal Reserve was created, the Federal Reserve Board was just a weak oversight body in DC. Okay, the fundamental strength of the Federal Reserve System at the time was that it was private and regional. The change in 1935 is now the FOMC carries out national economic policies, and that's a game changer. Under the Constitution, it's a game changer. The Supreme Court during the 30s and pretty much ever since then until very recently was very deferential. Whatever Congress wanted to do, whatever the president wanted to do, pretty much didn't object. And I think it's been a positive development. Personally, I think it's been a positive development. The Supreme Court has been revisiting all of that over the last 10 to 20 years to sort of say, we got to make sure that things are aligned with our founding documents. Otherwise, we're going to get into trouble. Okay, what does the Constitution say about this? It says that crucial national policies have to be carried out by officers of the United States. Read it, it's in Article 2. And the principal officers of the United States have to be appointed by the President of the United States and confirmed by the Senate. So we do have to make some changes to the Federal Reserve System in wake of 1935 and we're not going back to the gold standard. We have to make some changes. The regional Fed presidents, as Senator Toomey proposed, should become like federal judges. They're appointed by the president, confirmed by the Senate. That's my view. We can discuss it and debate about it, but that's the Constitution. And sooner or later, whether it's this year or next year, or still 5 or 10 years away, the Supreme Court almost certainly will reach that conclusion. Like it or not, that's where things are headed, because that's what the Constitution says, and we have a rule of law here, and we want to follow it. Okay, another part of the Congress is the boss. Congress in the Constitution is given the responsibility for the debt. We all know that, right? That's why we have a debt ceiling. Okay, well, who's the one agency in the United States that can create debt that's backed by the full faith and credit of the United States without any permission from Congress? It's not constitutional. That has to change, okay? So the Congress has to amend the Federal Reserve Act. Now, I think the way that Jeff was describing this could be a workable solution to it, something like Treasury bills only, because then the Fed has a clean balance sheet, assets and liabilities that balance short-term on both sides, and Congress is satisfied with that because the Federal Reserve's never really issuing debt. There's no zero net debt of the Fed. That would solve it. There are other ways to solve it too, but it's a constitutional issue. It needs to be solved. The Congress is responsible for what's called the power of the purse. Who's the only federal government agency whose budget and spending is not reviewed by Congress? The only one. FDIC, SEC, CFTC, all of their appropriations, all of their budgets and spending are reviewed by Congress. Even SEC, if most of its spending is covered by fees, or FDIC, it's covered by insurance premiums, it still goes through Congress in a review. Federal Reserve is supposed to do that under the 1921 Budget Act, and they've never followed it. It's never been submitted to Congress. That should change. And at some point, maybe the Supreme Court will require it, but it shouldn't wait for the Supreme Court to solve all these problems. Academic economists, monetary economists, market participants should help members of Congress understand this so that Congress can be a better boss. Last thing, Congress created 2 watchdogs in the 1970s. They recognized Congress doesn't have the capacity to really oversee the Pentagon. They don't have the capacity to oversee NASA. They don't have the capacity to oversee a lot of these complex, detailed things in many fields. What did they do? Well, they strengthened the role of GAO, Government Accountability Office. Very independent agency, nonpartisan, 15-year term of the Comptroller General. Who's the agency that got an exemption from comprehensive reviews by the GAO? Federal Reserve. Why? Well, at the time, the Fed was simple balance sheet, no risk, like, oh, we don't need that. And so Congress said, okay, we'll exempt you from GAO. That should change. You want Congress to be a good boss? You want to follow the Constitution? Then Congress needs a watchdog. Last, Inspector General. Every major agency of the federal government has an independent Inspector General appointed by the President of the United States, confirmed by the Senate. Only one exception, Federal Reserve. Why? Well, again, in the 70s, when the IG Act was passed, it seemed like, oh, well, we can just have our own IG who's a Fed employee, it'll work fine. maybe that wasn't unreasonable in 1978. Okay, this past month, the Senate considered a bill to establish an independent IG at the Federal Reserve Board. A fully independent IG that would be appointed by the president and confirmed by the Senate. That bill got 55 votes. Elizabeth Warren, who we all know is a progressive senator from Massachusetts, and Rick Scott, who some of you know is a very conservative senator from Florida, they're the two co-sponsors of that, along with Cynthia Lummis from Wyoming. Okay, this was a nonpartisan bill. 55 votes. It didn't pass because there's a 60-vote threshold. What I would urge all of you in this room to think seriously about is if we really want the Fed to have this balance of operational independence and accountability, then call your congressman, talk to your congressman or your senator, and let's get an independent IG. It's just the most basic, straightforward thing. By the way, I wrote a paper in June. I'm the last sentence here. The title of my paper in June was Mercatus Brief. The Federal Reserve should welcome an independent IG. I honestly believe that, and maybe it's going to have to wait till we have a new Fed chair next year, but I hope the Federal Reserve itself, because of what Jim said, credibility, and what I think Jeff said and Mike have said, okay, that you have to have accountability. The Federal Reserve itself should welcome an independent IG. Instead of lobbying against it, they should have been urging Congress to do it. I'll stop there.
Thank you. Okay, well, I think that's a good start. I think we should take some questions from the floor, and then get the panelists to respond. Okay, Houston, Anne Marie. What we'll do is we'll take a couple of questions, then get a response rather than each time. Okay, Hugh?
Law, do you think maybe Chairman Powell should voluntarily step down January? I think he's right not to step down now, but should he step down?
Why don't you speak to the mic?
Did you get the first part of the question? Or?
Sort of.
Sort of? Not all. Jim's shaking his head no. Right now, the chair is appointed for a 4-year term from date of confirmation, which does not necessarily correspond to when a new chair comes open every 2 years in January. Sometimes it does coincide, it works well, the new president has to wait a year before appointing a chair, but then can appoint a new member from outside the board or someone inside the board to be that president's choice as chair for 4 years, subject to the board, which is primarily earlier appointees. Do you think this should, it should be put in law that the chair should expire in January of the new president's end of the first president's first year? And even if it should not be in law, do you think, I think Chairman Powell right now is right not to step down, but do you think he, for the benefit of the institution, should voluntarily step down next January instead of when his term expires next May, and to put the chair and the seats back in sync as it often has been in the past?
Okay, thank you. Now, why don't you pass this on to Anne Marie? And by the way, that was Houston McCulloch. You should identify yourself. This is Anne Marie Muhlendyke.
Okay, Anne Marie Muhlendyke. I worked at the open market desk during a lot of the period that Jeff is discussing, and I applaud his even focusing on this subject because most people don't. And I want to add 2 things that I think are probably helpful is that the open market desk has a whole bunch of people who talk daily with treasury market makers, people out in the street. And the short-term focus of that group, which is very obvious, I mean, these are people who are almost always screaming for lower interest rates, and they like volatility to an extent, as long as it doesn't get out of control. Those influences have inculcated over that whole time period Federal Reserve thinking almost unconsciously. So the close relationship every day between the dealers in Treasury debt and the people who work at the Fed open market desk day by day should be thought about. But what I really want to bring up is the whole question of who makes the decisions on how much debt of each maturity is outstanding is theoretically the treasuries. It's very much indirectly the Federal Reserve's open market desk in its decisions of what to buy, guided by the committee. So bills only meant stay away from as much as you can as long as you're going to operate in that market. From the management of the structure of the debt. And of course, the Treasury could offset it. I mean, if they wanted to stop bills only, all they'd have to do is stop issuing as many bills. But I don't think those discussions were had, except between me and the head of the open market desk. And we always talked about, well, once we got past bills only, and that was ended by the time I got there, but was a bills preferably environment, should our buying be as little influenced by what the Treasury chose to sell or not? And it was in the back of our mind not to buy too many maturities that are scarce in the market, that are scarce in the outstanding picture. So as we weren't interfering. But that was a decision that was made by the economists at the desk. And I just thought I'd sort of throw that in as an interesting little piece of history. And Bob Rosa called me up and berated me when they had Operation Twist. Another little thing. I wrote a book about it.
Okay.
A little piece of.
Why don't we stop there? So
trivia.
why don't we get some responses from the panel? Jim, you want to go first, and then, or Jeff, doesn't matter. Okay.
Okay, so on Hugh McCullough's comment on the four-year term, this is something I've talked about in this year. Mine, and this will be a good group because I think there's good institutional knowledge about this. So when I came into the Fed in the 90s, and you think about, let's say, the original Greenspan appointment. Wait a minute now, this is 1987. That's the third year of the Reagan second term. And somehow over the years now, we're talking about first year of the president's, end of the first year of the president's term. So what's happening is that there's slippage because Congress may or may not approve a choice at some moment, and then the 4 years starts to count from whenever that moment occurs. So what has happened now is that you've slipped to May. But my understanding from the late 90s was that it got rearranged. There were delays in Greenspan's reappointments, so on. And then it got settled on 1 year into the president's term. And a lot of people informally at the time said, well, that's probably pretty good timing. This person is not a member of the cabinet. If you put it right away, then it gives the impression it's the same as the Secretary of State or something like that. So you don't want that. The arm's length kind of concept is that, okay, you don't want this wrapped up the same way you would with an incoming president and the new cabinet. but after 1 year, but the president's democratically elected. We want to respect that. So, okay, let's go with the 1 year timing. But the way it works now, it slips around, and so you don't always get that 1 year timing. So, should Congress put that into the law, I think that would be actually a very reasonable addition and a sensible solution to this, so that every president would get to name their Fed chair, but they would not in the same sense that they name a Secretary of State or something like that. But they shouldn't be, beholden to the previous guy's choice too far into their term. So that's part of the art of this arm's length from politics, would be movement on that particular issue, which I think is an important one. So I appreciate you bringing that up.
About the president, confirming the chair. Remember that the structure of it is that all members of the board serve 14-year terms. So it's modeled after the idea of looking at who's on the board and choosing one of them to be chair of that board. Remember that the chair of the FOMC is chosen by the FOMC. So it's a very different model of kind of committees and chairmanships that it's built on. So you'd want to think about appointing the chairs. So, but I don't have much to add to what Jim said. I loved Anne Marie's questions and observations. First of all, about the U.S., about the desks, analysts having frequent daily contact with a wide array of market makers, and that imparting a perspective that filters up to the committee. I think that's very true. I called this is sort of a bias towards the sell side, because these are people with stuff in inventories. They'd always like higher prices, or they're trying to sell something on behalf of someone. They'd always like higher prices for their stuff. And I in fact, a New York Fed president, who I won't name, told, when he assumed office, it's a male, said that he looked at what the desk was doing, and he said he decided they didn't have any representatives. They didn't contact people on the buy side, and he restructured their activities to beef up their focus on the buy side. I thought that was really notable. About the other point you made is that the Fed makes all these decisions that affect the term structure of what's held by the public. The Treasury makes them, we make them. There was the spectacle in the 2010s of us in the committee being asked to endorse something that altered the Fed's portfolio, whereas the Treasury was kind of doing something else, and the staff really didn't have much to say about what the Treasury was doing and whether they were cooperating with us or not. And it just was sort of silly in a way. An accord about Treasury Fed relationships to the debt market, I think, would usefully address that and have something clean. And yeah, it would have to, the Treasury would have to agree to issue enough bills so that there's a liquid bill market, and to sustain that, and so the Fed could operate in bills only.
So there's actually a deep connection between these two questions from Hugh and Anne Marie. So when the Federal Reserve was created in 1913, an important principle was to try to diminish the influence of Wall Street inside the Beltway, which I think is the term, maybe, I forget Jim or Jeff, which one of them mentioned inside the Beltway, meaning DC. And so the Federal Reserve System was created with 12 regional Federal Reserve banks that would, still give New York a prominent influence, but not a dominant influence. And DC was supposed to be limited influence. Okay, so what's changed over these last 100 years? And this is related also to the earlier concerns, I think, that Jeff and Jim were mentioning. Fundamentally, what's happened is the Fed chair has become dominant. The Fed chair, originally, with the way Congress envisioned it, was first among equals, like the Supreme Court. Exactly like the Supreme Court, the Chief Justice has to be one of the 9, okay? And it's coincidental if if the Chief Justice can be appointed from one of the existing justices, or if someone retires, then the Chief Justice can be appointed at that same time. Okay, and that's what Congress was envisioning, first among equals. That the Fed chair sets the agenda for the meetings and helps keep things running smoothly. Well, what happened? One thing that happened already starting in the 90s was that the Fed chair became dominant within the Board of Governors. Bill Nelson remembers some of this. I was there myself. There might be one or two others in this room who remember this time. But so Alice Rivlin was the vice chair. And I remember coming into work one day, seeing the Washington Post headline, Alice Rivlin has been appointed by President Clinton as the new head of the DC Financial Control Board. And I felt kind of sorry. I was like, well, Alice Rivlin, she was a great vice chair. I'm really sorry to see her go, but of course it's important. She's got to get the DC finances back in shape. And when I discovered by around midday that she wasn't leaving, she was going to continue as Fed vice chair. And Chairman Greenspin's view was, oh yeah, it's fine. I mean, she'll still have a few hours a week to sign things. Okay. Well, then 10 years after that, I was working for Rick Mishkin, helping write his speeches. And I learned that Rick Mishkin's planning to take a 1-month sailing trip in the Caribbean during his time as a Federal Reserve Board. And I said, Rick, how can you do that? He said, oh, it's fine. They don't really need me around here. Okay. So I think I disagree with Jim Bullard. I don't think the problem at the Federal Reserve Board is a problem of salaries. Look at federal judges. How many federal judges who are not the highest paid people in the world, and certainly many of them, they went to private practice, could probably quadruple their income. How many federal judges ever leave because I'm not paid enough and I want to go out to the private sector? No, because federal judges understand they have a critical role. They're serving the public and they have a real heart of public service. And I think that was the way things used to be in the Federal Reserve Board. Generally speaking, people would serve out their 14-year term. But when you get to a point where it's like, oh yeah, I can be gone for a month, or I can take on another job like DC Financial Control Board, and it doesn't really matter. And again, all 20 years I was there was a sense of the Federal Reserve Board members being marginalized, that the power became more and more and more concentrated in the Fed chair. One more thing happens 10 years ago. It used to be that the Fed Board had a veto power in the Federal Reserve Act over the choice of Federal Reserve Bank presidents. A veto power, it says it in the law, okay, they can approve or reject. But the understanding and the way it all worked, and I think Tom here can attest to this, is that the board of directors of the regional Fed would make the choice. And then the Federal Reserve Board would make sure that this person's not a communist spy, that whatever, some threshold, okay, that in principle the Fed Board could veto, but very, very, very rarely used. Now, what's happened in the last 10 years, the Federal Reserve Board, which really means for practical purposes the Fed chair, has basically taken control very tightly of the regional Feds. Their budgets, the selection of their leaders, the selection of the directors, okay? And so in 2019, DOJ, Department of Justice, Office of Legal Counsel, looked at this and they said, as far as we can tell now, this was as of 2019, the presidents of the regional Federal Reserve Bank should be viewed as subordinates of the Federal Reserve Board. And it's in a legal document, it's online, you check it, OLC 2019, subordinates. That was not the intention of Congress. Okay, so then we're back to Anne Marie's question here, because the point is that you now have a Fed chair who's dominant. The regional Feds have been subordinated. The other Federal Reserve Board members are kind of apprentices or deputies. Okay, then these problems of the links to Wall Street through the New York Fed and the links to politics and the 4-year term of the chair and the public's view that the Fed's now become very political, those are all related to these longer run trends that have been happening over decades.
Okay, let's go for some more. Okay, I'm going to take Honig and Mickey and Bill, 3. Tom, why don't you go ahead?
Thank you, Mike. I have a couple I guess, comments and a question. But number one, Andy, I agree with you on many points, but I have to tell you that the question of accountability is really, the Fed is doing pretty much what Congress wants. It's supporting their spending habits, right? So you have to start with accountability with Congress to reestablish a rule, not just the so-called dual mandate, but the fact that you're supposed to be independent from short-term political pressures so that you don't have to print the money for the debt. And I think that has to be firmly understood. If that doesn't change, this is going to go forward. And that brings me to Jeff's. I totally agree. I said it the other day. We need an accord to where we stop this accommodation to the Treasury and to the Congress of funding their debt along the yield curve, and keep it short and limited. And until we get to that point, we're going to go forward. And I have one third comment. The Fed is talking about now, if you saw Lori Logan's point, of changing their target from the Fed funds rate to the tri-party repo. If you're going to go that way, you're accepting the fact that the Fed should be a major holder of government debt to fund this stuff. And if that goes through, and we don't go back to scarce reserves, what's unlikely to do, it's like, again, going off the gold standard. There is no limit. So there's some fundamental things that have to take place here that are not on anyone's agenda, and they should be. And Jeff, to your point, at least we should be having discussions about another accord. Thank you.
Mickey.
Mike, in your opening remarks, you used the term accountability as a critical element, and other people like Jim has mentioned credibility, and Tom, you also mentioned accountability. I just think we need a further discussion about what are the key components of accountability, and just what does it involve, and how does it involve Congress, congressional supervision, Fed responses at all.
Right, okay. Bill? Yeah.
So I have a question that's somewhat related to Andy's final observations. There's a possibility that actively comes up in Washington, D.C., where I reside, which is, should the administration get sufficient control over the membership of the board, that then the board, when all of the Reserve Bank presidents come up for review at the end of February in 2026, would basically fire them all, or fire the ones that they didn't like, and then I guess, well, and then who knows how it would proceed from there. But that's basically would be this possibility. It comes up quite a bit, and I'd love to hear the panel's view on that possibility, on how that would play out among the Reserve Bank boards of directors, and well, that's my question.
Okay, so let's hear from Jim on this. Pick and choose whatever, you know.
Thanks for the questions. Maybe I'll start with this last one. So I don't think I maybe didn't get it into my comments, but okay, you've got presidential appointees at the board. You've got a process for selecting candidates to be presidents of the banks. That's run by the boards of directors of the banks. By the way, the board, at least on paper, appoints 3 of those directors for each bank, the so-called Class C directors. The A directors that represent the banks don't get to vote on that, so there are 3 other directors that are elected by the member banks. So again, this is an intricate arrangement that was thought of extensively by the founders of the Federal Reserve, exactly how they would do this, because they knew it would be a food fight over political control. And so they put all these provisions in to try to limit that. Also, the act says that the bank's boards of directors, the regional bank board of directors, would have all the normal responsibilities of any board of directors of a corporation. So you can hire and fire at will, particularly the president, the first vice president. So they pick somebody that they think is going to run the bank, but they have to run that by the Board of Governors. So I would say that the presidents are indirect presidential appointees because they have to get that approval really through the chair, but also through the committee. And so I think, if you put that in the president's, in the act, and you say, okay, all the presidents have to be appointees of the president of the United States. I mean, that does not sound good to me from the point of view of political meddling in policy. So I think you have the accountability that you need. The presidential appointees do approve of the presidents of the banks, and so I think that actually works. That actually works pretty well, and you don't have to get wrapped up in. I mean, the president of the United States makes thousands of appointments, and it's a totally broken process. So I don't know if you really want to go in that direction. You probably get a lot of openings that don't get filled and things like that. So will the Board of Governors now take its powers to the next level and simply fire all the presidents of the banks? I think that would be a food fight within the system. You've got these boards of directors at the banks, at the regional banks, who are movers and shakers in their communities. They're not going to take very kindly to that. And anyway, what would they do, even if you did that? Now they're going to propose new people to be presidents of the banks, and they're going to battle it out with the Board of Governors about who those people are going to be. I don't think that's probably a very productive way to go. And of course, now the governors can make a judgment that somebody's not, somebody's drinking on the job or somebody's not fulfilling their responsibilities, and they can ask the local board to look into it and see if they want to keep that person. So that can be done, so I think there are checks and balances within the system, and so I don't think that the Board of Governors it's not going to be very profitable for them to pick a fight over this.
About Bill's question, the Board of Governors, as Andy pointed out, has their approval is required for appointing a Federal Reserve Bank president, but they've taken that, leveraged that into an ongoing, like throughout the search process, the Board of Governors is involved. One of the governors is, they're getting the names from the search firm, they're just putting in their own names and so on. So it's become a process that the board has played a heavier role in, with the objective of making sure that the candidates are mainstream. Of course, one person's mainstream is another person's kind of conformist. So it's not clear the board understands the value of the diversity of views that a more hands-off approach would involve. Let me take a step back about this whole conversation. Link what Andy was talking about with this federal debt market. Remember that the idea of a central bank, this independent thing with private governance, it goes back to the Bank of England, 1695. And since people are talking about kings, the problem Parliament and the Crown solved was, we want to create a mechanism so the Crown can borrow, but not too much. And so the Bank of England can't lend to the Crown more than Congress lets it. So there's this fundamental sense in which the credibility of debt issue by the government is dependent on this relationship between these three parties: the Crown, the legislature, and the central bank. And that's what we have to sort out here.
The constitutional issue, and I hope every single person in this room, wants to stand for the Constitution, no matter what political party you're in or what many of your other views. Okay, that we want a rule of law in the United States. It's the only way to have sustained, broad-based prosperity and growth. You have to have a rule of law. Okay, so what does the Constitution say about this? The Constitution says that there are principal officers of the United States that have to be appointed by the president and confirmed by the Senate. clear cut. Now, that same section in the Constitution refers to inferior officers who can be appointed by the head of the agency or other mechanisms. Okay, inferior officers, and the Supreme Court has ruled for more than 100 years the distinction between the principal officers and the inferior officers. The inferior officers have to be subordinates. They have to be supervised by someone who's reviewing their decisions. Okay, that's what enables the chain of accountability. That's why OLC, when they were looking at this question in 2019, the deep constitutional question of how does the Federal Reserve System fit in the Constitution, and the conclusion they came to was it's okay because the regional Federal Reserve Bank presidents are inferior officers because they're subordinates of the Federal Reserve Board of Governors. Okay, I don't think that's what Congress wanted when they created the Federal Reserve, when they created the FOMC. They were not expecting that the regional Fed presidents were going to be subordinates whose views were going to be approved and supervised by the Board of Governors in DC. Not at all. But the fact of the matter is that as of 2019, OLC, which is pretty independent, at least at that time, was looking at all the information about the budgets, the appointment process, selection, and removal, and they came to the conclusion that, in effect, for all practical purposes now, the Federal Reserve Bank presidents have become subordinated. Now, you want them to set national economic policy, then the Constitution's very clear. If you want the Federal Reserve Bank presidents to be helping to set national economic, then they're principal officers. And then there's no choice. And we may not like the appointment process, it gets stuck, and the president, right? But we do that with federal judges and appellate court judges, and there's a lot of them. And we're relying on a judicial system. And so I don't see, and this is why I think Pat Toomey actually was very sensible in saying the right way to solve this constitutional issue with the Fed is to strengthen the roles of the regional Fed presidents, strengthen them, give them a 14-year term. They can be not even fireable by the president. They're agents of Congress, like the Comptroller General cannot be fired by the President of the United States. Only by Congress. Okay, so I'll end here, but just to say that these are complex, important constitutional issues, and we need to really think hard about them. And how do you protect the accountability and I'll say operational independence of the Fed together?
Okay, listen, this is it because we have to end on time. So thank you very much. But that was really illuminating.